It's a message of reassurance and staying the course. If I look at the last week, Thursday and Friday, we saw a 30% increase in the call volume coming into our call centers. But what we found was, for the most part, people were just seeking account balance information, maybe looking for advice, but trading activity was pretty de minimis. We didn't see much in the way of trading activity. I think what's happened is investors have learned to deal with these gyrations in the market, and they understand that these investments are longer-term investments. And the industry, I think the media has done a really good job of encouraging people to stay the course. And so that's what we're seeing right now.
Yeah, for sure. If you have a longer-term outlook, I'm not going to retire for probably 15 years.
Really?
I still, because of the ease of using your app, I'm still looking at it a lot when we have volatile days like this. Speaking of volatility, take a look at the indexes that were NASDAQ 100 up
Unbelievable.
More than 4% right now. We had the S&P continuing to climb now more than 3%. Do you see, again, because of how easy you've made it for people to interact with their 401ks, more activity? Like, are more people going in and saying, I want to change the balance, the mix of my portfolio, and actually doing it?
Not so much the balance, Matt, or changing the balances or repositioning, restructuring the portfolio per se. What we see is high levels of engagement. So we track usage of the app, we track usage of the website. We have 19 million customers, so we're monitoring that activity all the time. I think people really understand the benefit of dollar cost averaging. Most of our savers are saving through payroll deduction, so every 2 weeks or every week they're saving money in their retirement accounts. The one thing I would note, if you look at our wealth management business, we saw an increase of 200% in trading activity on Thursday and Friday. 75% of those trades were purchases. So the retail investor has not capitulated. The retail investor has stayed the course, and in some instances, I would suggest that they're leading this rebound right now. There's $7 trillion in money markets, the highest amount in the history that we've had in money market accounts. So I think there's a lot of cash on the sidelines that looking to take advantage of opportunities in the market.
Just trying to think long term for a second here, for even longer, because there is so much volatility. And even with today's rise, as we're seeing, at least for the moment, you are still seeing the S&P 500 wiping out roughly half of last year's gains. So yes, maybe Matt might retire 15 years from now, but what about the people who are retiring right now? What about the people who are living off that retirement income? How are they feeling? What are they doing? Well,
I think that's definitely a challenge. What you find, though, particularly for retirement investors, most of them are in a diversified portfolio. So when you look at an index like the S&P down in bear market territory, typically those in retirement accounts are not suffering losses that are consistent with the S&P 500 because of the diversification. 70% of the assets are in target date funds, multi-asset class type funds. So you don't necessarily see that level exposure. That being said, I think the concern that you raise is a real one. If you're in retirement or you're nearing retirement and you see this kind of a decline, it can be a bit concerning. And so, obviously we encourage people to have an emergency savings account, to have at least 2 years of expenses set aside in the event that these types of situations occur.
And, if we hadn't seen this big meltdown that we've seen over the past week, we'd probably have led this interview with the conversation around putting private assets in 401ks. But I do want to talk about that because one of the benefits of private markets is that, you don't have intraday prices unless, of course, you're in an ETF. But that volatility, that day-to-day volatility, you're kind of insulated from it, at least on a psychological level. So take us into that conversation, because it's been floated as a real possibility under this new SEC that you could see privates work their way into the retirement system.
I think we will. If you look at the markets, the structure of the markets have changed so much. We have 40% less publicly traded companies today than we had 20 years ago. You also have 87 to 90% of the companies in the United States with revenues over 100 million are private. So because we have this structural change, we have 125 million investors today that don't have access to the private markets inside the defined contribution context. And so Empower's I've been pretty outspoken about this. I think it's the right thing to do longer term. We could do it in a way that's safe. We could do it in a way that's cost effective. If you think about it, it's typically long-term money, long-term savings. And so you have the liquidity premium associated with private equity, private markets. And so I think the Trump administration and the legislature, I think, will work together, and we'll see the opportunity perhaps for a safe harbor for sponsors so they can feel more comfortable in offering these plans.
Ed, at the very least, I should be able to use ETFs in my 401k, shouldn't I? I mean, that lowers costs substantially.
Yes, Matt, but what I would say is a lot of sponsors haven't necessarily embraced the idea of ETFs because of the frequency of trading, and they want to obviously discourage that. If you look at index funds and some of the other low-based vehicles that are low-price vehicles that are offered inside the contribution plans, the price compression that's occurred over the last several years has been very favorable to investors. And so I would submit that with index funds and even with active funds, we've seen a significant decline in the expense ratios.
Ed, one thing I'm wondering is, are you seeing any kind of scary behavior in this market? For example, people taking out loans from their 401k to get through this period.
How does that graph look over the last year, say?
It's definitely increased, and I think there's a corollary to what you're seeing in the U.S. economy with deferred payments on auto loans, deferred payments on mortgages. So we've definitely seen an increase in hardship withdrawals, not material, but certainly an increase, maybe a 15 to 20% increase over what the historical norm is. And I think part of that was fueled by the inflation that people were experiencing, particularly last year and the year before. So that's something we monitor very carefully. It's an important consideration.